Did you know there's actually several ways to buy a house with 0% down? But some loan programs are better than others, and some of them have a lot of red tape. In this video, I'll go over 3 different ways that you can buy a house with 0 money down. If you're new here, my name's Nate. I'm a licensed loan officer that loves making educational content focused around mortgages and real estate. First, let's go over what's called a USDA loan or a rural development loan. Now, a USDA loan is cool because it's a 0 down loan and it's available nationwide. Now, although it's available nationwide, it's not available in every single area. With USDA loans, there are geographic restrictions. Now, to find out if a house that you want to buy is in a USDA approved zone, go to the USDA's website and check eligibility map. Another cool part about USDA loans is there's technically no minimum credit score, but we'll go over that more a little bit later. Along with geographic restrictions, there are also income limits for USDA loans, so it's possible that you can make too much money to qualify for a USDA loan. Now, those income limits are going to change depending on where you are in the country. They also change depending on how big your household size is. So 5 people living in a house in Florida isn't necessarily going to be the same as 5 people living in a house in New York. Now, earlier I said that there was no minimum credit score, but a lot of lenders are actually going to require you to have at least a 640 credit score. One thing that's unique about a USDA loan is that your lender will approve the loan, then they will send it to the USDA office in their local area. The USDA office will then approve it and send it back to the lender so that you can then go close. Real quick, let's go over the pros and cons of USDA loans, and then I'll talk about a loan that is 0 down with no PMI. The biggest pro of a USDA loan is there's 0 money down. Another pro is you actually don't have to be a first-time home buyer. That's a common USDA misconception. Now, with USDA loans, you're going to pay what's called a funding fee. So that funding fee is going to be due up front, and you can actually finance it into the loan amount. That funding fee is a 1% funding fee. So if you borrow $200,000, the 1% would be $2,000 that's added on top of your loan. USDA loans technically don't have PMI, but they do have an annual fee that is split up monthly. And that annual fee is equal to 0.35% of the loan amount. So let's say for easy math's sake, you have a $100,000 loan. Your 0.35% annual fee would be $350 a year. Split that up over 12 months and that's just shy of $30 a month. So let's go over some of the downsides of USDA loans. Earlier, I talked about how there are no minimum credit score requirements for USDA loans, which is technically true, but expect your lender to require at least a 640. And even at 640, sometimes USDA can be a little bit picky. Another con of USDA loans is that you have tighter debt to income ratio restrictions. So where you can maybe go higher on FHA or VA, that debt to income ratio restriction is going to be a little bit tighter with USDA. Another con is you can't use it everywhere. There are geographic restrictions. But don't hear the words rural development and think that you have to live out in the sticks. A lot of property that are suburbs of major metro areas are actually approved for USDA loans. Another con, we touched on this earlier, is that you can make too much money. So to qualify for USDA loan, you have to make enough money to satisfy the debt to income ratio requirements, but not too much to where you're over the USDA limit. Now with USDA loans, you can only buy owner-occupied residence, so your primary residence. Another downside is you can't buy multi-unit properties, so you can't buy duplexes, triplexes, or quads with the USDA loan. And because of the flow, a lot of times the USDA loans can take a little bit longer to close. Sometimes that's 2 or 3 days extra, sometimes that's 2 or 3 weeks extra, depending on how long your local USDA office is backed up. Lastly, a USDA loan is not a great loan if you're wanting to buy a fixer-upper. Now, if you're buying something that just needs some simple updates, that's okay. But if you're buying something with livability issues, more than likely an appraiser is going to point out those issues and those are going to have to be repaired before you close. Overall, it's a great program if you fit the mold. Next up, let's talk about a VA loan. VA loans are meant for people that have served or are currently serving in the military. Now, if you're not sure if you're eligible for a VA loan, talk to your lender and they will pull what's called a certificate of eligibility or a COE. That COE tells the lender whether or not you have enough VA entitlement or entitlement at all. Much like USDA, VA is only for primary residences. Also like USDA, there's technically no minimum credit score requirements. And it's up to 100% financing, including the funding fee. We'll go over the funding fee here in a bit. Some of the pros of a VA loan is there are higher debt to income ratio limits for VA loans. Technically, there's not really a limit. With VA loans, it's less about the debt to income ratio and more about what's called residual income. There's a certain calculation that lenders have to use to see if your residual income meets the requirements. If you have a higher credit score or more money in the bank, then you can usually push those debt to income ratio limits. Now, much like USDA loans, you don't want to buy a fixer-upper using a VA loan unless you use what's called a VA renovation loan. But with a VA loan, you can buy single family residences, duplex, triplexes, quads, townhomes, condos. And the best part is there is no PMI. Now earlier I said there's no minimum credit score requirements, but that's a VA guideline. Lenders will then tack on their own guidelines. Most lenders are going to require at least a 580. Some even require a 620. One cool thing about a VA loan that not a lot of people talk about is that a VA loan is assumable. So when you go to sell the property, if you are selling to a veteran, then it is possible that they can assume your VA loan. Now you're going to have to go through the VA and get approval for that, but it is a selling point if you have a really low rate. Some of the bad parts about a VA loan is you cannot buy a fixer-upper with it unless you use a renovation loan. Another con is there are a lot of nuances to a VA loan that a lot of lenders don't understand. It's kind of a specialized product when you dive really deep into it. So it's really important that you work with a loan officer that really understands VA financing. Another con is the funding fee. Now, the amount that you're going to pay in a funding fee is going to vary by your situation. I'll put the VA funding fee table so that you can calculate and get an idea about how much you're going to pay. Another con is it's a lot harder to have two different borrowers if the borrowers are not married. Now, it is possible if both borrowers are veterans or have VA entitlement. Lastly, let's talk about down payment assistance loans. There are a ton of down payment assistance loans out there, so I'm going to keep this pretty general. There can be state programs, county programs, programs that are from your city. For instance, I'm in Pensacola, Florida. There's not only a state of Florida program, there's an Escambia County program, but there's also a city of Pensacola program as well. And all three of those programs have some different nuances and are a little different. The best way to find a down payment assistance program in your area is to Google your state, your county, or your city, followed by down payment assistance. What I recommend is that you search all three and try to read up and find out which one is best for you. Now, with a lot of down payment assistance programs, the actual loan officer will have to do some special training in order for them to originate a down payment assistance loan. What I see most of the time is when you go look up these down payment assistance programs, there's going to be a section that says approved lender list. What I recommend is that you find a couple loan officers that are approved for the down payment assistance program you want more information on and give them a call. How a lot of these down payment assistance programs work is you have what's called a silent second mortgage. That silent second mortgage is money that you are borrowing for closing costs or down payment. A silent second mortgage is a mortgage that you're not making payments on. So what happens a lot of times with these programs is that after a certain amount of time, that money can be forgiven. But there are also programs to where that money is never forgiven. So if you go to sell, refinance, or pay off your mortgage, that money that you borrowed for down payment and closing costs becomes due. That's the main thing you want to ask your loan officer is what is the repayment like on this down payment assistance money that I'm using? The main thing with down payment assistance programs or any loan program for that matter is you want to try to find a loan officer that is there to educate you and help you along the way, not just pad their wallet. Believe it or not, this is just the tip of the iceberg, so I'll start making some more videos on these programs individually so we can dive a little deeper. At the time of filming this video, I'm licensed in Alabama, Kentucky, Florida, Mississippi, North Carolina, and Louisiana. If you need a mortgage in one of those areas, I'd love to help you out. If not, then feel free to subscribe and you can get more mortgage information like this. If you'd like to contact me, all my contact info is in the description along with my other socials. I post a lot of educational mortgage content. As always, if you have any questions or comments or you have a video idea, please drop them in the comments or DM me on Instagram. Until then, we'll see y'all next time.